you think about 1993, 1994, like 30 years back from now, India was a $300 billion close to GDP market, right? Now it is around 3.5 or 4 trillion, for example. So in 30 years, Indian market grew 13x in dollar terms. Back then, US was around, I think, $7.5 trillion market. Now it is 28, 29. So let's say roughly 3.5 to 4x. In that 30 years, had you invested, say, 100 rupees in 1994 in Nifty 50, that would have been around 3,500 by now, including the dividends, etc. The same thing had you done in S&P 500. If you think this is the market, is going much lower, that 100 rupees would have been 5,800 or close to 6,000. So the point is that you are actually not giving up on gains. To make it more juicy, these two markets are actually less correlated than you'd think. Okay. Yes. So if you can combine them together, the risk or the drawdown, right, when the market goes down abruptly, that lessens.
Folks, welcome to Paisa Vaisa. I'm yours Anupam Gupta, B50 on Twitter, and on today's episode, I'm talking about investing globally with my returning guest, Marcellus Investment Managers, but with a new person from their side, Arindam Mandal. He's here to talk about how and why global investing makes sense. All of that, folks. As you know, when we started this new year of 2020, now it's not new. Sorry, when we started this year. The very first episode we did was with Saurabh Mukherjee of Marcellus, and he was there also with us back in the year 2020 for the book that we had written, The Victory Project. And today, from Marcellus, I have with me Arindam Mandal, Head of Global Equities at Marcellus. Arindam, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Oh, thank you, Anupam. I'm glad to be here, and thanks for let us doing this.
I might be getting my pronunciations wrong because I am saying Arindam and Mandal, but I'm sure that in Bengali it's a little bit
no,
more.
it is fine. You're doing great, actually.
Forgive me for that.
No.
Let's get straight to the point, Arindam. Global investing, when the Indian markets are, they've become like this thing of delivering guaranteed returns and all.
Yes.
So let's start from there. Yeah? What's your view on that?
No, you're absolutely right. I mean, Indian markets have been bonkers actually last 3-4 years. There's no doubt about it. So, I mean, if you think about investing broadly, I mean, I'll point out three things here. Number one, the diversification aspect of it. As an investor, you don't want to put all your eggs in one basket. That's for sure. Now, the point is that either you can diversify across asset classes. So, you fixed income, equities, bond, gold, real estate. The other way to do it is you think about geographical diversification as well. So that part is what we are talking about. Because when you're doing diversification geographically, you are probably not taking the single country risk. And, I'm very positive about India's story for next 10, 20, 30 years. There's no doubt about it. But at the same time, risk is risk, right? That's why you call them risk, because it's unknown. And when you diversify, you're basically talking about keeping something away for when that risk play out in some way that you don't know. That is number one. Then the second thing is that it can actually add value, or it can actually add more wealth after 10, 20 years to your entire journey of building wealth. Why I say so? I mean, if you think about like the global markets, the US market is the largest market, and the typical disconnect that people has is that India is growing at 7, 8, 10%. You put a number, right? So if that is the case, then the stock market should grow much more than that, or at least it should do the best. Which is probably it makes sense, but there is no correlation in terms of economic growth and stock market return. I mean, China is a great example, and then you can take Indonesia, Philippines, etc. Now, of course, I mean, India is a very different market. It is a free market, so that works. If I put some statistics around it, if you think about 1993, 1994, like 30 years back from now, India was a $300 billion close to GDP market, right? Now it is around 3.5 or 4 trillion, for example. So in 30 years, Indian market grew 13x in dollar terms. Back then, US was around, I think, $7.5 trillion market. Now it is 28, 29. So let's say roughly 3.5 to 4x. In that 30 years, had you invested, say, 100 rupees in 1994 in Nifty 50, that would have been around 3,500 by now, including the dividends, etc. The same thing had you done in S&P 500. If you think US is the market, that's going much slower. that 100 rupees would have been 5,800 or close to 6,000.
Wow.
So the point is that you're actually not giving up on gains, right? To make it more juicy, these two markets are actually less correlated than you'd think.
Oh, okay.
Yes. So if you can combine them together, the risk or the drawdown, right, when the market goes down abruptly, that lessens, right? So for example, during COVID or during GFC, Indian market went down by say 50-60%
Yep.
in dollar terms. US market was down probably 30-40, right? Now if you can mix and match them, your drawdown goes down. If your drawdown goes down, that actually leaves you more dry powder. So you can actually allocate the market that didn't go down that much to the market that actually went down much more than that.
Yeah.
So that is the benefit that you get from, doing this kind of allocation. We did some work on, the correlation, how the, wealth creation might help, etc. in doing this diversification. It actually does quite a bit. So this is the second point. So first point is, diversification. Second is around this, you create more wealth. Third thing is the dollar liability, building dollar liability. So if you think about it, Indians are getting richer, right? I mean, if you look at the Hurun's rich list, India is number 3.
Correct.
And if you look at the mass affluent part of the Indian market, that is also growing very steadily.
Yeah.
So in that case, if you think the mass affluent, the consumption pattern of wealthier in part of India basically, a lot of things that you consume are actually not made in India.
Correct.
Right? So if you think about you content in Spotify, Netflix, Amazon, everything. So we are actually making dollar consumption, right? But we are building our wealth in Indian rupees, bulk of it. So the point is that, at some point of time, as we get more connected with the rest of the world, which is actually great development, right? In any evolution of any country, if you're connecting to the rest of the world, is good for both our country as well as the rest of, like, all the people that live in the country. You should think about building a bit of dollar liability. Now, why it matters? So many of our kids will be probably going to US, UK for their higher studies. There's a very practical example of it. If you think about the MBA cost of doing an MBA in Harvard, for example, say 35 years back in 1990s, the tuition fee was around, I think, $15,000 per year. Now it is around 60, 65 or 70. So 5x, close to 5x in 30 years. So 7 to 8% of dollar inflation.
Yeah.
Right.
Yeah.
You might say that I can build the wealth here, then I can send it over, when it is needed. The point is that it is practically very difficult to, send that lump sum of wealth in a different currency because you have to go through different route, etc. Right? So it is always good to build some part of dollar wealth. It is your currency is hedged in any case for future expenses, and so that you can basically sleep better at night. So that is our pitch. I mean, that is why you want to do global investing.
Amazing. So if I were to just recap that for our listeners, you said that the first was diversification, which is a necessity any which way. And diversification in terms of country.
Yes.
Okay. Second was this whole thing about how you're getting a high return at a lower volatility.
Yes.
Okay. And the third was of building dollar liabilities because you're going to need that at some point of time. I think those three things make a lot of sense. So folks, there's a very comprehensive answer to the question of why global investing if India itself is growing so well. I like the point about how even if you're looking at 7 to 8% of education in the US, you add another 2% of dollar of rupee depreciation. Thankfully, that rupee depreciation used to be 5% at one point. Now it's come down to maybe 2 or 3%.
Right.
So you're saying that I will need something that grows at 10% per year.
Yeah.
Irrespective.
Right.
And this offers, an opportunity for me to consider an option.
Right. Absolutely.
Fantastic. Now, who is global investing ideal for? Okay. Is this like only for HNIs? Or can someone with a much smaller portfolio maybe do an SIP? Or can that investor also do this?
They should do it. As I said, the mass affluent is going to be the bigger part of our strata, right? I mean, if you look at the demography, etc. And when you are, say, in your mid-30s, right, you probably have a 3-4-year-old kid. After 14 years, he or she will be going to a college. So you should start building a part of your investment portfolio, investing in the global stuff, right? So there are a lot of options available. So you don't have to start with a huge corpus of money to invest in global. So to your point, I mean, it is actually applicable for anyone, right? I'd say anyone, because as the country is getting richer, it actually applies to all.
Now, coming to the GCP product, I think GCP stands for
Global Compounders.
Okay, so the Global Compounders portfolio, what is it? Is it a PMS or an AIF or something else?
It is a PMS, it's a portfolio management service. The reason we thought about starting with a PMS structure, because the PMS structure is much more transparent. Because, like if you know the Indian PMS, you actually hold the stocks under your name. So it's not part of a fund. So that transparency comes with the PMS structure. And GCP as of now is a PMS. It is based out of Gift City. Right. So the reason we went for Gift City, because it is kind of a DIFC or Singapore equivalent of what we are trying to build. Right. So it is made to, bridge between the inbound or outbound flows that is coming into India. So I mean, there are a lot of benefits in the Gift City from tax perspective, etc. for us. And even for the investors also, it can take money from anywhere in the world for that matter.
So, if I have understood this correctly, you're saying that, like, I know how an Indian PMS works. I have a fund manager.
Yes.
I have the stocks in my demat. The fund manager is free to buy, sell whatever he wants, and I get taxed on each transaction for capital gains at the end of the year. Right. And there are some cost profit sharing, etc. Could you just explain to me how does this work in case of GCP?
It is the same. The construct is very same. You have to pay capital gains tax based on the churn, right? If you're selling or buying any stock. The cost can be divided in three ways. One is the fee that you pay for us for managing this. The second is the brokerage. And the third is the tax that will be taken care by you. No, we are not doing the taxation, right? The brokerage part is actually very tiny, because we are investing in probably the most liquid markets across the world, right? So there is, I think, very minimal, like 5-6 basis point.
Okay.
That's it.
Okay.
And depending on the, there are different fee structures that you have. So depending on that, you have the fee. And the churn part, the tax part on churn, that is something a little bit different, because the global stocks are not listed in India.
Correct.
So they are considered as unlisted equities.
Okay.
So the taxation is as per that unlisted equities.
Which is how much?
For resident Indians.
Okay.
So for that, it is the long-term tax is 12.5, which is same as the domestic. But the long-term is 24 months. It is not 12 months.
Okay.
And within that, it is the short-term is actually marginal tax rate. So that is a little bit penal. So in that scenario, you have to make sure that you're not churning the portfolio too much, because it might add some value optically, but if at the end of the day, it might actually...
it will, right? Because if you're someone who's an HNI, then if you're doing short-term capital gains for him, and if he's in the high slab, he's looking at 43%.
Yeah, 42%. Yes, absolutely. Yes.
Whereas if it is long-term capital gains, then it's on par with listed equity.
Yes.
So 2 years is what you're looking at.
It used to be actually 20% plus indexation.
Correct.
Unlisted. They changed it. So it's a very positive change, I would say, in that sense.
Okay. Arindam, let's get into the process of selection, right? Because... I have no idea about how this works. These are global stocks. India, you could say PE, growth opportunities, and I don't know what not. But what do you guys do there in the US? I've read some of your newsletters, of course, and it seems quite interesting. It's very different from how people here just, and bull market mein to, it's just, you just buy anything. I'm sure globally, the fundamentals or the selection process should be different.
That is true. I mean, look at the core of it. It is very similar. I mean, I typically tell everyone that building and managing a portfolio is very analogous to building and managing a cricket team, for that matter. So you have you're the basically selectors to some extent. In cricket, you're scouting for talents and eventually bring them to NCA in Bangalore, and eventually build a probable team, and finally it goes to they go to play for India, and based on the pitch, etc., you select the final 11. Very similar that we are doing here, because there has to be a process to the madness. Because if you are doing global, the opportunity set is huge.
Okay.
Right. It is good at one side that you have a lot to choose from, but it can be very distracting as well. So the selection part, what we did is like, the first part is definitely which geographies you want to invest. So for
Okay.
that, we wanted to limit ourselves to the developed markets, primarily US and certain pockets of Europe.
So you start with geographies.
Yeah, so that is
Like
what
a top down or bottom up, depending on how you look at
it
it.
is.
Okay.
Yeah, so the first screener is like, okay, stocks which are listed in North America,
Hmm.
US, Canada,
Hmm.
and developed Europe.
Something like a Europe. Okay. ठीक है.
Developed Europe,
Yeah.
right? Western Europe, basically. Western Europe plus Nordic.
So that's like Germany, France, UK
Sweden,
stuff. Okay.
yeah,
Sure.
all that stuff. So that is the first filter that you put in. Then, like you're looking at batting average, etc. for cricketers, or strike rate.
Hmm.
What we try to do is that we try to find out companies through screeners that how through a business cycle this company has performed.
Hmm.
How is the consistency of performance? Because consistency eventually wins,
Hmm.
right?
Hmm.
So that is again a kind of rigorous process because we have built filters around, say, cash flow, the typical financial jargons that you have: cash
Okay,
flow,
okay,
revenue, return on cash flow, and all that stuff. But basically, the goal is very simple: if the company has been consistent through various business cycle, because at the end of the day, if you can survive, you end up making money.
Sure. Yeah,
Right?
yeah, of course.
So that is the goal. That is the screener. But you'll be surprised to know, Anupam, that even though our starting universe is around 1,500 stocks,
Okay.
once you apply this consistency criteria across different parameters, it actually takes out almost 90% of the universe.
Wow. Similar to India, I guess.
Similarly, yeah, it is.
Yeah.
So 150, 160 stocks, that's what we eventually get.
Yeah.
And after that, I would say we apply the forensic framework.
Hmm.
We are kind of very conservative in terms of, when you're looking at companies.
Hmm.
So you'll probably not find many of the popular names that you hear because either they are not making money
Yeah.
or too volatile, or they have very aggressive accounting practices. So you don't find them in this portfolio.
Okay.
But the point is that we spend a lot of time in understanding the DNA of these companies. Okay, so that involves travel. That involves talking to a lot of stakeholders that are involved in the ecosystem. For example, we invested in a company called Intuitive Surgical.
Okay.
So it is kind of a monopoly in robotic surgery.
Wow. Okay.
It is a monopoly, and it makes actually a lot of cash.
Sure.
The point is that when you are they have a ROC of like 40%, 50%. So when
Wow.
you are a monopoly, you are making so much of profit, then the first concern comes to us that is it sustainable? Because in this current world, there is no dearth of capital.
Correct.
The capital is going to be there. Now, to understand that, we try to identify, how did the company build its monopoly over last 20, 25 years? Then you understand that, the surgeons who are basically the consumer of this product, they're actually sold into this product. I mean, and they're a very closed community. And when you start your career, like as a student, for example, you start practicing in these machines, right? So when you start your professional career,
Sure.
you don't want to switch
Sure.
unless there is a real need, right? Not only that, what we understood is that a surgeon, they're reaching their capacity. I mean, they gain their name or fame by the age of 35 or 40. When they're 55, 60, there are physical limitation that comes, right? They cannot stand for long for doing 3-4 hours of surgery. Now, if you're using these intuitive machines, the Da Vinci, actually find it everywhere, literally.
It's called the Da Vinci machine.
Da Vinci.
Wow.
Yeah, Da Vinci is the name of the brand.
Right.
So you'll find that, it is like a console, gaming console, put it straight away, right? So you get in there, you are actually doing your operations in a kind of that console, and there's a robot actually doing the real procedure, right? So you don't have the trouble of standing for long. If your hands are trembling, etc., that is not a problem. So we understood that doctors are kind of, why they like it. The patients like it because, the length of stay in hospital, that reduces massively.
Oh, okay.
Yes, right? So and there less blood loss, etc. The problem is, these are not cheap surgery.
Correct, yeah.
So there are two other counterparts. One is the hospital management team, another is the payers, which is basically your insurance.
The insurance
guys,
companies,
right?
yeah. That's what I was going to. That's what I was wondering.
Right?
Insurance companies. Yeah.
Yes.
Go on, sorry.
Yeah. So that is where we thought, okay, let us check with them. Like, what is the compulsion? I mean, given that their claims ratio, etc., is going up. We talk to the insurance companies. across the Europe, Australia, US, of course, India, and the hospital management teams that what is making you actually do that? The answer was very clear that, if everyone in the ecosystem likes it, we do not have any other option.
Wow.
And the hospital management team's point is that we make money because of surgeons actually. They are a profit center. You don't make money from OPDs, right? So if you have to keep them happy, the best way to get these machines, I take some hit, but at the same time, you get to do your job best. So the point is that once you do this kind of research for every company, it helps you to take a stance. Otherwise, it is very easy to dismiss a company like Intuitive Surgical. Like, okay, this is very high cost of high return.
Sure,
so there will be a lot of competition coming in, and it is pricey stock.
Yeah.
Which is true, but this depth of research you have tried to build over time.
Wow.
For every stock that you look into.
Pretty exhaustive.
Pretty exhaustive. And the third part is basically, again, coming back to the cricket analogy, you want 11 Tendulkar cannot win a World Cup in a team.
Yeah.
So you need players for every kind of capability, every requirement. So that is where we try to make sure that the investment universe that we have different kind of stocks. It is not very homogeneous. And the best part is that in India, you're talking about economic growth. That is a very easy sell, right? If you are investing in Western world, the themes that you get exposed to are actually very, very different. You have an Intuitive Surgical in one side, then you have an Armis, which is making those handbags, right?
Oh, you've invested in Hermes.
Yeah.
Wow.
Right. So that is the kind of different themes that you come across, and that is exactly our point. That it is not just diversification by geography, but you're actually diversifying across themes that you never get access if you're just investing in India.
Crazy.
Right. So the final leg is that you have this diverse set of companies which are attending to different themes. The beauty of that is if one part is getting too expensive in valuation standpoint, the other part is generally not.
Okay.
So that gives us a chance to add value doing portfolio construction. In the same way, right, for every pitch you have different combination of batsman and bowler based on the requirement. So here is the business cycle and the valuation that helps us to put the final puzzle together.
Lovely.
And that's how it works.
I like the comparison with the pitch, with cricket per se, and of course team selection and stock selection. By the way, you ever attend an analyst meet for Hermes and they give you bags or anything? Just if that.
I have done. I did it in 2016 probably.
Okay.
But it was just it's not a full-fledged bag.
Hold on. Is it a US company or European?
Paris. Yeah.
France. Lovely.
Yeah.
Awesome.
France.
Okay. You mentioned two stocks, Hermes and Intuitive. What are the other stocks? If you could just help our audience understand, just you don't have to name them. If you want to name them, then great. Roughly, what are their profiles and maybe a few of them, just for a...
Sure. Typically what we do is we try to divide our portfolio in three broad buckets. The largest bucket is the pick and shovel, that's what you call them. The pick and shovel, the term was coined during the gold rush. And people who was actually mining for gold, they barely made any money. The guys who were selling pick and shovels, they ended up making money. Yes. So we tried to pick that theme. And the classic example we typically talk about is ASML, which makes basically lithography machines, which is kind of critical for any chip manufacturing process.
Correct.
Right? So it really doesn't matter, if you're using iPhone or Samsung. I think every one of us, the phone that we're using, it has the chip that comes into that.
Very interesting.
It is made by ASML. So most likely.
Yeah. So you're saying don't buy the phone manufacturer, don't buy the chip manufacturer.
Yeah.
I think USMC and TSMC are listed in Taiwan.
TSMC, we have TSMC, so you can buy chip manufacturer, but at the same time you have the ASMLs of the world.
Perfect.
That is
Go
also
on, please,
as well.
right? Okay.
Similarly, if you are investing, suppose in you are bullish about air travel. So again, that comes back to the point that we are getting connected globally. If you look at the air traffic growth across the globe, it is around 2x of real GDP, 2 to 3x. So real GDP growth of the world is around 2 to 3%. So the air traffic growth is around 5-6 over a long period of time.
Okay.
And you want to play that because it's a higher than GDP. Anything that grows above GDP is a theme that you want to play. How do you play that? We don't play it with airlines.
Correct.
Right? You can't play it with Boeing or Airbus.
Yeah. Or the manufacturers of the planes.
So we play it with the manufacturer of the parts, the spare parts.
Okay.
So every time you are taking a flight from Bombay to anywhere, you just open your seat belt. You can see the very high likelihood that the seat belt will come from a company called AmSafe. AMSAFE.
Okay.
So we have invested in a company that actually owns AMSAF. Transdime is the name of the company.
Sure.
So there are quite a bit of aerospace spare part manufacturer, that kind of companies, which are kind of monopoly
Okay.
in those specific parts. So AMSAF has a 95% market share.
Wow.
Right? And if you think about from the airline perspective, these are the items they typically do not care about the cost.
Sure.
Because it's a seat belt, right? There are so
necessity.
many, necessity, but it is not that expensive.
Yeah.
If it is expensive part, it will come into CFOs like first 2-3 line items, right? Cost item. But this is like, that threshold, below that threshold. And you can actually get a good price hike on that, right? Because it doesn't actually bother you. So that is one thing, one theme in the pick and shovel that we tried to play. That you have massive pricing power. You are adhering to a global mega trend of air traffic. Very little chance that new competition would come in because it is not easy to get approved by FAA. For every part that you have, it has to be approved by FAA.
Always,
right? Regulated. So a nice sweet spot of compounding over time. That's the biggest part. The second is basically intuitive. We call them utilities.
Okay.
For utilities means, the beauty of utility is that it has a very predictable cash flow.
Okay.
And the usage to its end user is kind of an utility.
Sure.
So utility, so for Intuitive Surgical, it is an utility for the surgeons.
Okay.
And it also has the recurring cash flow angle. So what Intuitive does is, the Da Vinci machines, they cost around $2 to $3 million. Okay. But it is just 20% of their total revenue.
Okay.
For every surgery, you have to replace certain parts.
Okay.
So that is a consumable part of it.
Wow. Okay.
It is a razor blade basically.
That's where it comes
Yeah.
from. Okay,
So that is the 80% of its recurring revenue is from that high margin revenue.
Sure.
And predictable, because you broadly know how many surgeries are going to take place, right? It is kind of slightly above GDP given that we are aging. So that is again utility. The third bucket is the consumption bucket.
Okay.
Okay. So the third bucket is consumption. That is where the armies kind of names come in.
Got it.
It is actually very different from the dal chawal kind of consumption that we talk about in India.
Yeah.
Right?
So you shouldn't look at it as staples, discretionary, or durables or whatever.
Yeah. So we are looking at the premium consumption.
Okay. Luxury.
Luxury.
Okay.
So the reason we're looking at that, actually you're right. It is luxury. It is not premium.
Yeah.
Premium is, Audi is premium.
Maybach is probably
luxury, right? If you think about who are the consumer of these luxury products, a very simple way to look at it is probably the dollar millionaires. It's a very starting point. And if you look at various reports, you'd find that the number of dollar millionaires are growing at a 6 to 7% CAGR.
In the US?
Everywhere.
Globally?
Globally.
Wow.
Right? So we talk about this polarization, etc. This is actually real. Right? The rich are getting richer. The poor are getting probably, not that lucky. So what you notice is that 6 to 7% cohort is actually, growth cohort is very unique.
Okay.
In the sense that, of course, it is much higher than the population growth. Population growth is 1 to 2% globally, right? You're getting 3x of that. And for their necessities, they're actually willing to pay up. Sabun tel mein problem hi hota hai na, that we get into, like, price बढ़ गया, that kind of elasticity is there, right? Downtrading. Here you're catering to the people who actually would love to pay you more if they can get the stuff at time, right? If on army's bag, the typical waiting period is around 6 months to 12 months if you want to get the Birkin bag. And people will do anything to get up in their queue, right? So that is a pattern, and the interesting thing is that there are not many companies which actually does that.
Okay.
It is just, Ferrari, Armis, there are very few. So Armis is one of those. Another company that we invested in is called IDEX.
Okay.
It is the largest manufacturer of pet diagnostic machines.
Okay.
So if you think about pet care, when we were growing up,
pet diagnostic machines.
Pet diagnostic. Wow. They're basically 60% market share in pet diagnostic. It is not a huge market, right? It is a tiny market, but very niche market.
Very.
And the way we treat pets now is very different from how we used to treat them 30 years back.
Correct,
Right?
Of
and
course.
It is, you can say that it is a thing of riches, but it kind of adheres to the same premium consumption. Right? You think about these grooming stores that you find in the upscale Mumbai, in everywhere actually. And the pet consumption spending is actually growing at almost twice that of GDP.
Okay.
And IDEX kind of companies, the beauty of this is that the markets are not big enough to attract people.
Yeah.
You become a leader there.
That becomes a barrier of entry.
Yeah, right. And you make the vets make more money. The more tests you do, actually get something out of it.
Crazy.
So these are the kind of themes that we are trying to add to.
Got it. Okay. Just winding down the episode now. One is obviously, is the construct working for you? This is what it's been 2 years now to the portfolio.
Yeah.
How has it performed?
It has been actually going to be 2 years. Yeah. So we have delivered around, I think, 31% CAGR net of fees.
Okay.
And in the same time, the benchmark is S&P 500 for us. The benchmark has done around 22-23.
Not bad. Yeah.
So I have delivered decent amount of alpha with very low churn actually.
Sure.
We missed out on few big opportunities like the Nvidias of the world, but it was, in one side, it was painful that you missed out on that. But the other side, it is good to see that despite missing some of the big names, the portfolio still did pretty well.
That's good to know.
Yeah.
What do you think are the key risks to this approach or to the GCP as such?
Look, broadly, it is a relatively low risk portfolio.
Okay.
But it is a long only portfolio. We are not taking any short position. We don't take any cash calls or anything like that. So we are always invested. So the broad risk is the general market risk.
Correct. Yeah.
Right. So if you are exposed to the geopolitical risk that you hear about, so we cannot take those out. Very hard to take out those risks. But that is broadly, I would say, and it is a 25 to 30 stock portfolio.
Okay.
So it is concentrated, but it is not that concentrated that, it can, if one or two stocks doesn't work, it breaks your entire portfolio.
25 to 30.
Yeah, 25
nice.
to 30.
It's just at the sweet spot for PMSs.
If you look at global funds, it is generally 60 to 70, but we wanted to keep it 25 to 30.
Okay, I think I was looking at Indian PMSs.
Yeah, Indian PMS, you will find a lot of 25 to 30.
Yeah. Okay, folks, the product is called the Global Compounders Portfolio, GCP. It's a PMS, which means that you need 50 lakhs plus to invest.
It is a little different. So it is a PMS out of Gift City.
Okay.
So the minimum regulatory is around $150,000.
Okay.
But there is another accredited investor regime. So you need some paperwork to do. For that, we have kept it at $25,000.
So what is that in Indian rupees?
22 lakhs. 22.
So, so it's about 25 lakhs, you could say 22 to 25 lakhs, which is different from the Indian PMS construct. But if you want to know more, the Marcellus link to the GCP portfolio is given in the episode description. Of course, you can reach out to the good folks at Marcellus and they will happily answer all your questions that you might have. And then we are done with the episode. Our standard final question, and when Saurabh was here, I think just you ask him, he can go on and on talking about it as a separate podcast, I guess. But what book are you reading, and do you have any recommendations for our listeners?
Recommendation standpoint, if you think about investment book to start with, I always recommend The Outsiders. The Outsiders by William Thorndike. There's a...
Come on,
there's a very common recommendation probably.
I'll grab some of that credit because when Saurabh wrote The Unusual Billionaires, I was very lucky to be part of. The Outsiders was like a
Bible.
Yeah. What a brilliant book.
Right. So William Thorndike. And the second book, I'll recommend, it's a biographical book by the name of Junk to Gold.
Okay.
So it's a biography of Willis Johnson, who is the founder of Copart. It is the largest online salvage marketplace.
Wow.
Salvage market, very unique. How he founded the company. It's basically how you can make money out of a scrapyard. Amazing. So that is the title, Junk to Gold.
Where did you get that from? The book. Where did you hear of the book? Where did you get the recommendation for the book?
I used to cover the stock.
Copart. Okay.
Yeah, so it is one of our investing companies now also. So I used to cover the stock, and when it came out, and of course it's a great read.
I like the references you've made out here about 2016 for Hermes, and now that you covered this at some point. So what's your background? I'm just trying to figure
I started my career around 2012. I moved to US in 2012.
Okay.
Then started working, did my MBA, started working for principal. Started as a generalist, and that's why you'll find me having the privilege to attend many events by larger companies. But eventually I specialized in industrials. And towards 2018, 19, I moved to emerging markets.
Okay.
The
Okay.
emerging market side of the financials. This is a broad. I mean, the coverage increased over time. But yeah, so had the chance of covering many sectors during my time. During my stint at principal, and Copart was a industrial company.
Nice.
Theoretically, it is
Yeah.
not actually industrial, but by the the sector classification,
Sure.
it was an industrial company. So Copart is one. My company is fantastic. I mean, it is a massive 100-bagger, 300-bagger, and
Amazing. Yeah.
and you cannot actually the beauty of this book, I feel, is that you can actually make money out of the things that you can never imagine.
Yeah.
From a
Sure.
scrapyard to
Sure,
billionaire,
sure,
right?
yeah.
So that is second. The third one I would recommend is it's a long read by Victor Sweets, The Great Rupture. That is the name of the book.
The Great Rupture. Yeah. Victor Schwartz is a very familiar name. I can't place
Yeah,
him.
he's a strategist at Macquarie.
There you go.
Yeah,
Macquarie strategist.
Macquarie
Yeah.
strategist. So his thought process is very unique, and what he did in this book is he compared. He went to history, like hundreds years of history, looked at the Russian, Ottoman, and Chinese empire, and how they scrambled. In their final years, and at the same time what the West was doing during the same point of time, and how it shaped the modern world that we are seeing.
What was the name you said?
The Great Rupture.
The Great Rupture.
Yeah.
3. Any more?
The one I'm reading actually is the Victor's latest book,
Okay.
The Twilight Before the Storm.
Okay.
The Twilight Before the Storm. It is also nice. I mean, it's kind of a continuation of the Great Rupture, but it draws very nice parallel of the modern world
Okay.
versus the 1930s and 1950s.
Wow. Okay.
So basically, the extreme financialization of the world,
Sure.
and where you stand in terms of capitalism, the modern form of capitalism, etc. It throws very unique light towards these things. So, I mean, so far I've not completed it, but so far has been a great
So
read.
folks, 3 recommendations and one which he's reading. First, The Outsiders. Second, From Junk to Gold. Third, The Great Rapture. And the fourth which you're reading is called
The Twilight Before the Storm.
The Twilight Before the
Yeah.
Storm. The last 2 books are by Victor Schweitz. From Junk to Gold is the story of
Willis Johnson.
Willis Johnson. And of course, The Outsiders is a business classic that all of us should read by Peter Thorndike.
William Thorndike.
William Thorndike, sorry
Yes.
about that. So folks, with that is a wrap on this episode of Paisa Paisa. My guest, Arindam Mandal, Head of Global Equities at Marcellus. Arindam, you've come all the way from Bangalore. Have a good stay in Bombay, and thank you so much for doing this for our listeners.
Thank you. Thank you, Anupam.
Fantastic.